We're starting to see that awakening. And I think as that movement grows, we're going to get farther down that path to where we finally get true price discovery in the precious metals markets.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is Robert Kientz from goldsilverpros.com. Robert, thank you so much for joining us today.
Thank you, Elijah, for having me back on the program. I appreciate it.
Definitely. It's great to have you. And I kind of wanted to get an update from you about what has fundamentally changed since this whole silver squeeze phenomenon. You know, at Miles Franklin, we've been seeing just record demand ever since the beginning of end of January, beginning of February, when this all started on Reddit and all of that. What is your take on kind of the changes we've been seeing in really the market itself?
Well, you know, I've been following this market for about 12 years when I wrote my book, Drop Shadow, The Truth About the Economy. I was actually, the way this all started, and I'll give you a little bit of background on me for your viewers who may be seeing me for the first time, and then I'll answer your question if you don't mind. So I started this journey about 12 years ago. I was laid off in February of 2009 from Ernst & Young. I was working for the Big Four as a consultant. I'd made my company $7 million on a contract, which would have paid my salary for over 100 years at the time, and they laid me off. And I asked them, why did you lay me off? And they said, well, we have to trim down because we're not getting the same contracts. So the economy had frozen and they were cutting staff, even highly productive ones like me. And so I thought, well, that's really strange. I had followed the system. I'd followed what everybody had told me and gone to school, got a job, worked for a professional accounting company. And here I am getting laid off. We just had my son a few months ago, our second child. I have to make mortgage payments. I'm like, what the heck is going on here? So I began to look into the economy. And when I looked into the economy, I felt like I was staring into the abyss, right? And there are lots of things that we could talk about that. But in any case, that's when I woke up to studying the economy, looking at the precious metals, so on and so forth. And the reason I bring all of that up is because now has changed quite a bit, not only from the last few weeks and what we saw with the squeeze, but also since the last financial crisis. Where I think we are, and I'm going to talk general economic first and then the metals. Economically, we're very end stage here in this bull market. Traditionally, we have financial bull markets last about 4 to 10 years, and then we have a recession, or in every 80-ish years there tends to be a big event like a depression, or 80-ish years from the last depression. So I think we're in the super cycle stage of where we're setting up for the next big crash. And that's what I wrote my book about, Drop Shadow, The Truth About the Economy, about 12 years ago. I think all of that has led people to wake up to the issues with the financial system. So you saw it on Wall Street bets, and you saw people starting to take more chances. I think people are realizing they need to find alternative methods to seek value. And so some people were doing that by shorting, penny stocks, and then they got into shorting or going along some of these micro caps in order to bid up the price. And then that kind of spilled over into silver, because there were a lot of us have been following silver for a very long time and saying, this is undervalued, this is undervalued, this is undervalued. We're having shortages. The miners can only put out 800 to 900 million ounces a year. Look at this demand exploding. Over 1 billion ounces. The Silver Institute thinks this year we'll have over 1 billion ounces needed in the economy. There's not a lot of above ground silver because of the way that it's distributed so many millions and billions of times in these products, little amounts. So it's not as easy to recover as gold, and only a portion of it's recovered as scrap. And so people were looking at, what about silver? What if we squeeze silver? And so there was a movement, I think, to go into SLB, which is a derivative product really intended for generalist investors to get price exposure to silver. And then it kind of went over into PSLV, which is Sprott's, which is completely different than SLB. It's more tied directly to physical silver itself, and it's a closed-end fund, so it's not really, you can't really build it into a bubble. And so a lot of that occurred. And then we saw the shortages at the end of January, beginning of February, started to see shortages. Miles Franklin was reporting them. SD Bullion, all of the big bullion dealers here in the States, were reporting that. And so what we saw was a movement. And what I saw was a movement into silver. And it wasn't just us old-timer gold and silver bugs. It was a younger generation. It was a millennials who I've credited for waking up, seeing the situation they're going to be in as a generation, because this is their prime earning time. A lot of them are getting in their 30s. This is supposed to be the best time of their lives, and they're seeing all the financial issues. So they're saying, I need to prepare for this. And so they went into silver. But they started off with SLV, and then we got the word out that, hey, SLV doesn't really allow you to redeem for the silver. Maybe there are other options. And so then it shifted over into all forms of physical. And I think this movement is building. We're not seeing the price explosion, but that doesn't surprise me. That has to do with the futures market, and we can talk about that if you want. There are controls in place around how the futures trade, and it's the paper futures that determine the silver and gold price, not the physical trade. But the physical demand has just exploded, and it's moved from those early derivative products that really are meant for generalist investors who don't have real exposure to silver into the physical. And that's why I think we're seeing the shortages. And as we talked about before we started recording, there have been reports from some people saying that the 1,000-ounce bars that you would get on the COMEX, or that you can get through, a limited set of retailers, if you have about $30,000 to invest in one of those, are starting to see shortages. Now, there are some out there, but there aren't a lot. And you have to remember, silver market is very tiny. So any amount of generalist investor movement into silver is going to absorb that very, very quickly. And you're going to see, the big price uptick that we've all been waiting for. So what I see is a lot of this bubbling below the surface, but there are more people interested in precious metals, and specifically silver, than I've seen in my 12 years following it, even after the last financial crisis. And that's a very positive thing, because it's a movement. It's not a short-term deal where people are speculating like Wall Street bets in GameStop and AMC. It's more of a movement thing. It's got some legs behind it, and we're seeing that develop over time here, and it's actually really encouraging.
Yeah, definitely. That's one of the things I'm hearing is people aren't jumping into precious metals right now to get rich or something like that. It seems like it's a movement. Did you want to expand on what you said about why the big demand we're seeing, for example, at Miles Franklin and other dealers are seeing, isn't translating into a higher spot price, how the spot price is more set from the futures contracts?
Yeah, and this is where it gets really complicated, because the spot price that you'll pay at a physical dealer, when you pay that at a physical dealer, you think it's local supply and demand, or it's some market that has to do with physical, and it's not really. The way, in order for commodities to have some level of price stability, is that we have to have this futures market where, let's say, for example, you're producing corn, and you're a farmer, and you've got to plan how much can you plant, how much can you spend on fertilizer, how much can you lease equipment, so that you can get your corn to market. And there may be a 5 to 6 month planning process, and actually planting it, getting it on the ground and putting it in a silo, processing it, and then taking it to market. So over that 5 to 6 months, you have price exposure, and that price exposure could bankrupt, smaller farmers, because they work on sort of a yearly sort of situation with being able to finance their business. So the futures markets came about for legitimate hedging. Legitimate hedging is when you're a producer or a merchant who's going to be using it, and you have price exposure, and you have to plan that risk out. So the futures markets were started with good intent. But what happened with the futures market is now there's much more speculative activity in that market than there is actual physical trading. So if you look at the precious metals specifically, gold and silver are delivering much fewer contracts on a daily basis, the physical, than what we're seeing in the futures trading. The futures trading is hundreds or thousands of times bigger. And that's a speculative activity, because those aren't all legitimate hedges, because you have these big bullion banks getting in it, and you have the hedge funds getting in it. That's all for price speculation. So essentially what happens is the price gets determined now by that futures trade, and sort of in conjunction with the London markets. The London markets are these over-the-counter unallocated markets. I won't get too far into that. It's probably for another program, but those two together kind of determine the spot price. So what I do a lot on my channel is I go into the CME Group's website, and I look at the price activity, and I tell you why the price is moving based upon how the futures are being traded. So to shorten that, to summarize it, the futures trading determines spot price. And that paper trading has a different set of rules than what you see in the physical, and it's different players. They're not there necessarily to take possession of the physical. They're there to speculate on the price. And what we see in addition to that, and I'll add one more aspect of that, there are 4 and 8 traders who have concentrated positions shorting the precious metals, both gold and silver. And those tend to be the bullion banks mostly, but they also could be some other large financial entities. And when you have that large of a concentrated position shorting a paper market, which has nothing to do with the physical, they're called naked shorts, because those contracts don't require physical to back them. whenever you have that much naked shorting, it keeps the price within a certain trading range. And I would argue it actually disrupts the market from doing what it's supposed to be doing, which is overall price stability, because where, let's say, silver should be going up higher in price due to shortages would actually help the producers of it to produce more. The biggest cure for high prices is high prices, and the biggest cure for low prices is low prices, as Rick Rule says. And that's true. You have to let the market determine that. When prices rise, we can produce more. When prices fall, we produce less. The futures market don't really allow that mechanism to work. And so that's the issue that we're having. And that's why you have this massive shortage in physical silver, but the price just isn't taking off. And I also further think that some of the people that are shorting silver may be taking physical delivery for their own means, because when you have that much control of a market and you can get physical cheap, why not do it? It gives you an advantage.
And with respect to that, how you're saying there's a lot of naked shorts out there. I've also heard the perspective those shorts are actually just hedges for physical positions that their clients have, right? So, and the truth is, well, we can't actually verify that because we can only see the shorts, right? The client positions are just a private thing. So it's kind of a interesting situation because it's like, well, how do we really know what's true? How do we really know the positions? And at the end of the day, at least for my research, it's like, it seems like you can't really for certain, but what is your perspective?
Yeah, so one of the things you have to understand about the gold and silver market, it's fairly opaque. So you can't see transactional trades in physical or necessarily in the futures either. And they're different markets. You have probably 15 decent sized markets around the world. The biggest ones are the LBMA, the Shanghai, in China, and LBMA's in London, and then you have the COMEX here in the United States. And there are a bunch of other ones. There's some in the Middle East. You've got them in Japan, the TOCOM. But in any case, not all of them report the data in the same way. Not all of them trade the same way. There's more physical traded on the Shanghai as a percentage of trades than there is in London or the US, for example. And in London, it's more of an OTC market where all of it's private contracts. And then you go over to the COMEX and they do report the futures positions, but they only report them in aggregate or bulk level. They don't report individual transactional amounts. So you can't, for example, I'm a former auditor. When I look at that data, I cannot what we call tick and tie or balance the credits and the debits of each transaction because we don't have the ledgers. We don't have the overall CME group ledgers aggregated up, and we don't have the individual participant ledgers. So without that, like you said, you cannot validate all of the individual transactions. One more thing that I talked about last night is there's a loophole called de minimis, which the CFTC passed in 2019, which allows the bullion banks that are the authorized participants in the ETFs, by the way, to go into the market not as bullion banks, but as basically semi-autonomous entities and have unlimited amount of futures trading. And so what that means is if you just look at the data, for example, around February, where we had all of this physical demand and the silver short squeeze and Wall Street silver was becoming very popular, the SLV took in supposedly 110 million ounces. But we know that there wasn't really 110 million ounces available. So where did they get it? They had to go to the OTC markets. They had to go to these derivative markets and get derivative exposure. And if you look at what was going on in the futures at the same time, why didn't that explode the price? That's the number one question, and the question you asked me. When we have this record demand going to SLV, we have people, buying out all of the online retailers. We're starting to have trouble finding 1,000-ounce bars. Why didn't the price explode? Well, because at the same time all of that was going on, in the span of 3 days, there was something like 2 billion ounces of silver. That's more than two times the entire production of 2020 from the miners. Contracts negotiated on the COMEX in 2 days. So on average, we had the entire annual production of silver from the mines traded on the COMEX for 2 days straight. So that's why, because when you have that much paper sitting on top of the physical market, that's what controls the price, is not the physical. And that's really how that mechanism works.
You mentioned how there was this inflow in SLV, and you're saying, well, that's actually not possible. And some of it must have been not physical silver. Can you dive into that a bit more? Because is that allowed with the SLV or is it supposed to be 100% backed? How does that all work?
So I'll give sort of the short answer here and give you some resources you can go and research. So the SLV basically stores it in London. So there wasn't that much London silver available according to what was publicly available data. Now, there could be private transactions in private stores, but we're talking 110 million ounces. That's over 1/10. It's about 12-13% of annual silver production. And getting that in 3 days, and SLV basically stated they got it, meaning it was already sitting. The only way to get physical that quickly is it's already sitting in the warehouses, and all you're doing is taking a label, a piece of paper, or on the computer, on a spreadsheet, and basically re-tagging metal that belonged to person A now to person B. In other words, you're putting a warrant on it, but you're changing who owns it. We don't believe, based on publicly available data, there was 110 million ounces available. They can't ship it from COMEX had that much available, but a lot of that's in private hands. So you would have to convince the private people to sell. You would have to do that transaction. You would have to settle. On COMEX alone, on their website, the CME Group website, on COMEX alone, just the process of changing owners takes 3 to 4 days. We're not talking about shipping it over, getting it on an airplane, getting it inspected, going through that proper process, putting it in the London vaults. It's physically impossible. So they couldn't have got it from the vaults. There wasn't enough there. They couldn't have got it from the U.S. Where did they get it? They had to hedge their position by going to the OTC markets. And on the CME Group website, it says this. It says authorized participants of these ETFs use the OTC markets to hedge, short term by going to the OTCs. Now, OTCs basically what it means is it's fractional reserve. So you have X amount of metal, and then you have so many more claims on top of it. Obviously, not all of those claims can be redeemed in metal, but it offers a certain amount of quote unquote liquidity for these types of transactions. And according to the CME Group website, the authorized participants of GLD and SLV and other ETFs use those London OTC markets to have metal exposure, but it's on a paper contract position, not on the physical. So could they eventually get the 110 million ounces? Sure, not in the time frame they said. It just was not liquid. It was not available. And even if it was liquid, you couldn't physically move it over there in that amount of time. That's how we know.
One of the reasons it seems like one of the things behind the silver squeeze, at least a lot of people who are buying physical metal, right, is they see this situation that you're saying is the case where it's like the futures contracts set the spot price and the physical demand, from dealers around the country that doesn't really have as much of an impact. They kind of see that situation and are like, well, it should, right? Shouldn't the spot price be based on the physical metal? And they're like, well, maybe, buying the physical metal, making a statement that way will finally make an impact, and impact the spot price to reflect the physical demand. Do you see that as a possibility?
I do. And going back to why the markets are created, years ago, I worked for a currency broker. When I got laid, when I talked about getting laid off from EY in 2009, I could not find a job in my field. So I had a friend that worked at a currency broker. And to work at a currency broker, if you're going to be interacting with customers, you have to get a Series 3 license. It's one of these financial licenses from the government. Currencies are covered in that, and all commodities are covered in that. So I learned about the currency and commodity markets through that Series 3 and passed that Series 3 exam and was licensed. And plus, there's the immense amount of training I went through at the currency broker. So I got really interested in commodities markets. There is a reason for the futures markets to exist. It is for legitimate hedging. It's to allow the producers and merchants to have some price stability. What's happened, though, is that market has blown up, like I alluded to earlier in the video, and there's too much speculation. So your question essentially is, can physical overwhelm speculation? It can. However, it's going to take a little bit of time, and it's not meant necessarily what people think. The first thing that people want to do is they want to invest in SLV. Then they realize SLV has within their prospectus, public and always have had, provisions that state we may not be able to get the silver. Same thing with GLD, by the way. So everything I'm saying for SLV will apply to GLD for gold. We may not get it. We may not get it in the quality that meets our standards or anybody's standards. We cannot regulate or audit the holdings of our sub-custodians, which most of the silver for SLV is not in JP Morgan's vault, the custodian. It's in sub-custodian vaults or other third parties that are holding it for SLV. So we cannot guarantee that all of that silver that they say backing SLV is actually there. So, so going to SLV, and they also said they just amended the prospectus last week to basically say, we may not be able to get the metal, and that's just a risk you have to take in investing in it. So you're not going to go to SLV and cause a short squeeze. Last night, I offered a lot of new information talking about COMEX, where the futures are traded here in the U.S., and about the CME Group and the CFTC, which regulates them, and all of that boils down to is they have so many loopholes and provisions that if they run out of physical, they can force you to settle in cash, they can halt trading, they can kick people off the exchange, they can do anything they want to keep market integrity. In other words, you can't bankrupt them. They're not going to allow you to, because the rules as codified in law, and we showed the Cornell Law website where this is actually codified into U.S. law, basically state that you can't run the COMEX because they can change the rules of the game anytime they want, and they have something called a global command center which allows them to do it. So they're watching all the trading, global command center. Think of computer screens everywhere, people sitting in a room like NASA, they're watching all the trades. With a click of a button, they can change anything they want anytime to stop a run on COMEX. So you're not going to do it that way. The way that if you want true price discovery in physical gold and silver is to go buy physical gold and silver. Because eventually what happens, if the COMEX runs out of physical gold and silver, they become essentially, in most people's mind, an illegitimate market. Now they can still function. They'll still be there. By law, they can still operate. But what credibility would they have? Fiat currency is just a confidence game. When people lose confidence in the dollar, we've seen with fiat currencies, 100% of them over history, they hyperinflate. The same thing can happen with some of these trading markets. If you lose confidence in the stock market, it crashes. Why do stock market crashes occur? People sell. It causes a run on the stock market. It collapses. Same thing with a bank. You go to the bank, you start withdrawing money. They don't have enough cash to meet obligations. They've invested it out. You cause a crash in the bank. Same thing can occur with SLB. Same thing can occur with the futures markets. But you don't have to go through those markets because there's only so much physical. So if you know there's only about 1 billion ounces produced a year, give or take, and you know that we're having shortages, you just buy it all. There's a shortage. The only way to get more is to raise the price. It's the only way. It's the only way you're going to pry it from the private holders of the COMEX. It's the only way you're going to get it from the miners to go produce more mines, which, by the way, takes 3 to 4 years to increase mine output. So when it goes up, it can go vertical on silver. We saw that in 2011 as it touched on 50. And we saw it last year as it went from 11 to like 29. Silver goes vertical very, very quickly. But it can go past 50. It can go to 100, 200 when there's enough demand. Because remember, silver is a very small market. And to replenish those supplies, it takes 3 to 5 years to get those mines producing more silver. So that's really what we're dealing with. And I think that's what we're setting up for now as to when that occurs. That really depends on everybody watching this video, because it's all of us making individual decisions. In other words, it's a marketplace, a global marketplace that makes that decision as to when that's going to occur in silver. And I think the last couple of days of January and into February, we're starting to see that. We're starting to see that awakening. And I think as that movement grows, we're going to get farther down that path to where we finally get true price discovery in the precious metals markets. I think we're a lot closer than we were, say, 12 years ago at the last financial crisis.
And speaking of true price discovery, what would you say would be like the fair value of silver, right? Because you're talking about it going possibly above its all-time high of 50 and even higher than that. Do you think it would stay around that because that's just what the fair value would be? What is your perspective?
So historically, over 6,000 years, and I did a nice infographic in my website 2 years ago about this, silver's been money for 6,000 years, even longer than gold, about 5,000 years. So there's a monetary aspect to silver and a definite monetary aspect to gold. Silver's different because there's a lot of industrial demand. So it's got 2 demand factors: industrial, investment. And I would argue that jewelry is really investment because people buy it, and yes, it's for adornment, but they also hold it for long term and they sell it back. So it's really, I think, a sort of investment demand. So the price can go as high as people that make a demand for it. Now, if you want to just look at dollars printed, this is a common way to do it. If you want to look at dollars printed, you would look at $20,000 to $30,000 for gold and maybe $1,000 to $2,000 for silver. When you compare the amount of them produced historically, silver's produced to gold about a ratio of 15 to 1. And you look at the amount of money printed, that's a simple way to do it. You'd have gold 20 to 30,000. You'd have silver, $900 to $1,200. That would be in sort of like a dollar crisis scenario where people lose confidence in the dollar. Maybe we have hyperinflation. Maybe the Fed is panicking. It's all over CNBC. The metals could eventually get there. I think shorter term targets, if you look more at a ratio of how much silver there actually is to what the derivatives exposure is. You could be looking at anywhere from $100 to $600 silver. You can be looking anywhere from $3,000 to $4,000 gold, and that could happen more quickly. That's more of like a year to 2 year term outlook, whereas the higher prices I mentioned is more of maybe a 4 to 5 year, depending on how the dollar does. And there are other reasons why we could lose faith in the dollar. Probably, another conversation, but there's all sorts of reasons why that can happen. But that's maybe more of the medium to long term.
In your perspective, I guess worst case scenario, do we just see gold and silver kind of going sideways, continuing to go sideways, or if we don't see, as you call it, like this true price discovery?
I think it's going to range trade for a while. So gold and silver are a little bit different. I'll address gold first. Gold is in a consolidation pattern, and if you look since 2011 to now, it's in a cup and handle. A cup and handle is essentially you have this sort of formation, and then the handle is sort of a down sideways 45-degree angle retracement. Gold is in that, and that's an extremely bullish technical formation, by the way, for people who do technical analysis. Once gold finishes its retracement, we're expecting it to hit its next bull leg. That can be 4 to 5 months, 6 months, maybe a year, but I don't think it'll be that long. So gold could retrace down to 1,700. That, I think, is probably its bottom, and then it's going to start maybe the last leg of its bull cycle, at least during the dollar's lifetime, what we consider the U.S. dollar's lifetime before it eventually dissolves as all fiat currencies do. That's sort of the timeline I'm looking at gold. Silver's different. Silver's very volatile. Silver usually doesn't make its big pop until gold first. Gold makes it first, but when silver gets momentum, it goes harder and stronger. And so I'm really looking at gold first. And to know when gold's going to go, I'm really looking at the banking system. I'm looking at potential black swan, default risk. I'm looking at all these countries dumping the dollar. I'm looking at the bond market. So the bond market and bank collapse is what's going to really portend the next giant bull cycle. When that goes, nobody really knows, but we've started to see Chinese banks get bailed out by the Chinese government. We've seen Chinese state-owned entities, which are corporations that are basically like governmentally owned and run, start to get bailed out last year. That financial contagion is spreading across the world, and we saw what happened with the shutdowns and the deflationary period we had. So I think we're at the end of this current bond dollar run. And so I think it can happen sooner rather than later. And when it happens, it could be fairly violent upside in the precious metals because there's so much debt overhang and so much of a bubble in the stock market and the bond markets. But I think we could sideways trade for a while. I think people should be prepared to be patient for 6 to 9 months and use this as an accumulation phase. And I want to speak specifically to your younger viewers here who may not be gold and silver bugs, but are just discovering this for the first time, or maybe older people who have been invested in the general markets and now they're starting to think about precious metals. Use this as an opportunity. Yeah, there's shortages now. Yes, there are some high premiums on silver specifically at the retail dealers. In my opinion, don't worry about that. Accumulate now, because when this final leg occurs, you're not going to see these prices again for a long time. I'm talking 3 to 4 to 5 to 6 years. Because when that occurs, you're going to have to reorganize the financial system, the Great Reset that people are calling it. That, by the way, the World Economic Forum has already put on their website saying it's already begun. So I think you have limited time in this range trade to get your gold and silver. And then when that reset happens, that financial system reset happens, you're not going to be able to get it. So I say look at this as a buying opportunity and don't worry so much about the time frame. I think the die is cast. We know what's going to happen. Use this opportunity to build your gold and silver if you're interested in doing that.
All right. Well, Robert Kientz, thank you so much for joining us today. Before we let you go, where can people find you online, and any last thoughts you'd like to add?
So yeah, people can find me on my website, goldsilverpros.com. They can also find me on Twitter and YouTube under Gold Silver Pros. We have a free newsletter. If they go sign up there, I send out alerts whenever we do new content. We also have a paid subscription for those who want to get a little bit deeper into the market, go through some training courses, and have access to our quarterly newsletter.
Awesome. Once again, Robert, thank you so much, and God bless.
Thank you so much, Elijah. It's a pleasure to be on your program again.